Okay, market indicators measure the health of the market. They quickly gauge how the market is reacting to news and general sentiment. So these become effectively, if I use the car analogy again, these are our temperature gauges, these are our battery charge gauges, this is our tachometer. So we get to see how the engine and stuff like that behind our stock is operating. Some of them are watched simply because the masses watch them. If I were to walk out onto the street right now and there's a guy walking down and I say, wow, the market's up 50 points, he's going to assume I'm talking about what? The Dow Jones, okay? The Dow Jones, though, is only 30 stocks. It doesn't really show much, but does it matter? It's not reality, people, it's perception. People react to things they think they know, that they have heard, and they don't have to be true even to have a reaction to them. So we have to understand that this market works on perception. Once again, be flat, okay? So when you look at the Dow Jones going from 10 bucks to 10,000, it looks like it's going up, but you have to remember they're only showing you the best of the best. By the way, who picks the stocks for the Dow Jones Industrial Average? Anybody? You ready? The editors of the Wall Street Journal, okay? And in their wisdom, in 1999, November of 99, they pulled out Sears and Goodyear and put in Microsoft and Intel. It was the first time ever that NASDAQ stocks became a part of the Dow Jones Industrial Average, okay? Interestingly enough, of course, 5 months later, we had the tech bubble bust of 2000. If they were to take Intel and Microsoft out of the Dow right now, which is trading, what, around 10,100, and put Sears and Goodyear back in, we'd be almost at 11,000. They didn't choose very wisely, did they? That's how hard Intel and Microsoft were hit. Okay, cost almost 1,000 points of Dow points. Alrighty, the NASDAQ composite. Right now, in the NASDAQ, there's about 3,400 stocks, major stocks. Okay, there's always a couple thousand of the bulletin boards. The penny stock was trading at around $4.25 or so. Well, it has so many shares outstanding that even at $4.29, Sun Micro is still a large cap. Okay. Obviously, the NASDAQ has over the years attracted an awful lot of the high techie stocks, okay? So it's very tech-oriented. Yeah, the NASDAQ has Starbucks and the NASDAQ has Bed Bath & Beyond, okay? But who really controls it? The Microsofts, Intels, Cisco's, Applied Materials, Oracles, PeopleSoft, all these major companies that have all this cap weighting in them. We then have the S&P 500, okay? And the S&P 500 is put out by Standard & Poor's. And Standard & Poor's decided what would be the best, the perfect diversified portfolio for an investor. And they selected all sectors, 500 of the best stocks in the United States. And they say if you bought this 500, few of us could afford it, but if you bought all 500 of these, you'd have the perfect portfolio. Now, needless to say, just like the Dow, do you think the S&P 500 changes its membership? Yeah. Okay, and of course, Standard & Poor's gets to say who goes in and who goes out. You ready? Now, the S&P is denoted two different ways. And we can see up here it says SPX cash. Now, I'm going to make this simple. I don't want to get into all the math of it. But simply put, they add up all 500 companies, the price of all 500 companies, and divide by 500. This gives us an index unit, okay? And the S&Ps are currently, as we saw in the charts, is trading right around $1,100 per unit, okay? Now, it goes up and down from there. Now, that's what it's trading for today. That's SPX, the cash market. But we also have futures. Futures are traded not too much by the public. They're traded by professional traders. One lot, one contract of S&P futures right now would cost somewhere around $250,000 to $260,000 to go out and swing 10 lots, or 20 lots. Okay, you gotta have some real horsepower behind you. The S&P futures also trade 24. I'll say 6. It's actually 24.5 and a half. They open on Sunday evenings and close on Friday afternoons, East Coast time. Okay, so we lose all of Saturday and a piece of Sunday. But otherwise than that, they're traded around the world, not just in the United States, but by Japanese traders, by German traders, by Italian traders, by Swiss traders. All over the world are always trading it. For you, let me get my handy dandy marker. So first off, if we look up here at the board, we know that SPX is equal to the cash, and that is equal to what it is valued at today. Everybody with me? We then have the futures, and the futures are described by the root symbol SP, standing for Standard & Poor's 500, and then we put in a contract month. Now, this being the time it is, okay, we're going to be trading the June contracts out in the future. And the contract month, I'll put them up here in just a moment, is currently M. Okay? And then generally we will add the year that it was done in. So the S&P futures June contract 2004. Okay? So these are people who are buying. If the best of the best, who can swing the biggest money, think the market's going to be up in June, should we be buying our stock now? Yes. And that perception, whether it's true or not, is irrelevant. It's the perception, okay, gives us a correlation. And you're going to see it. I'm going to show it to you time and time again how this works. And this is basically the only leading indicator. The S&P futures traders trade their contracts. The stock traders watch the S&P futures. Futures go up, stock traders buy stocks, the stock goes up. S&P futures traders sell contracts, the stock traders watch it, they sell their stock, the price of stock goes down. There's a correlation. Now, let me just put up the months up here for you. The letter H is equal to March. M, as you already found out, is equal to June. The letter U, as in Union, is equal to September. And the letter Z, zebra, is equal to December. Where do these letters come from? Well, from the CFTC, the Futures Trading Commission, okay? And there's other cycles. This is what we call the calendar cycle or the March cycle. It goes the major calendars, March, June, September, December. But there's also the January cycle, okay, that goes January and then April and July and October. And then there's the February cycle, which goes May, August, and November. Okay, and they have their own letters. But these are the ones we concentrate on here. Now, all of these contracts close on the third Friday of that calendar month. Now, be careful, because the third Friday is not always in the third week, last week, okay? And that's where everything expires at the same time. Regular stock options, future commodities, future indexes, okay? And now we have single stock futures. So it used to be called a triple witch, now it's called a quadruple witch. And when all these contracts start to unwind, as people take delivery or make delivery of their contracts, the market becomes very volatile. And generally, my rule of thumb, and maybe you guys might think about adopting this, quadruple riches are days that you go to the beach. Good time to go play golf, because the market gets really crazy. It really gets mixed up. It's just a little too volatile to look for decent repeating patterns. Everybody with me so far? Questions so far? Okay, let's move on then. We're going to put this into action now. Okay, there's some other things that we need to look at. We have other futures up here. We also have the NASDAQ 100, which is NDX, and that's cash. And then we can have the NASDAQ futures, okay, and that would be the NASDAQ 100. And their call sign, as you can see, is NQ, and then it says 3U on this particular platform. So it's NASDAQ 2003. What does the U stand for? September. Very good. And then it has a G because that particular contract is being traded on the Globex market. There's different markets for things. You guys know the NASDAQ and the New York, but you know, maybe you've heard about the Chicago Mercantile Exchange, where commodities are exchanged, or the CBOE, the Chicago Board of Exchange, where options are traded. Well, futures are traded there as well. And they also trade futures on an electronic trading platform called Globex. So it gets a G at the end of it. Alrighty, we can also look at the bonds. Pretty much bonds are contrarian to stocks. If the price of bonds is going up, then people are buying and they're taking money out of the stock market to buy bonds. So if bonds are going up, stocks are generally, not always, generally going down. And vice versa. If the stock market looks more appealing, like you're going to get a better return on your money, money will flow out of bonds and back into the stock market. So as bonds drop, the market generally, not always, goes back up. Everybody with me? There's other ones. There's a lot out there. Al made the remark, he didn't even know that the biotechs or the drug companies had their own index. Okay? Well, there's about 179 different sectors, and each one has their own little letters, their own little code sign, so that you can watch them. And as I suggested to you at the beginning of the class, that if we're going to do this as beginners and we're going to do this intelligently, we need one strong stock in a strong sector so that when the S&Ps or the NASDAQ futures go up, our stock will go up. It'll be correlated to it. And we need one weak stock in a weak sector so that when the S&Ps futures go down, that stock drops like a rock, huh? So if we know those things, we then maybe need an understudy. So we look at the sector. So perhaps if we chose Intel, well, that's a chip maker, okay? Well, is AMD in the chip making business? Sure, okay? And maybe if that's the strong sector, we're looking at that. And of course, in 2003, the semiconductors came up like wildfire, alrighty? We may go out and look at something else. I suggested perhaps if you wanted to look at financials, because we're in a low interest rate environment right now. We might look at Goldman Sachs and his first two lieutenants, okay, or the first lieutenant. Think about a dog sled team, guys. We want to play the lead dog and the first two behind him at best, okay? They're the ones that get up and pull the hardest. They know where they're going. They're the leaders. The ones at the back of the dog sled team, they don't know that they're going anywhere until their chain has been jerked, okay? And then the view isn't real appealing, okay? So we need to think about what we want to play. We want to play the leaders in the sector. So we can look at the Russell 2000. We're also going to look at some internals here like TIC, TRIN, and yes?
I don't understand sector.
A sector is a group of stocks that do the same thing, okay? First off, you have an industry. An industry is the financial industry, okay? And that includes everything, right? Credit cards and brokerages and banks and S&Ls, savings and loans, and all those. Now, in a given sector, we could look at just brokerages, David. Okay, Merrill Lynch, J.P. Morgan, Charles Schwab, Goldman Sachs. They're in a particular sector, but they're in the general heading of an industry called financial. But they're a specific financial. So a sector is just a subset of an industry. Got it? Good. Now, here is a shot of the S&Ps and a stock, and I guess we have Amgen up here. Let me get my pointer. Okay, so if you'll notice up here, we have Amgen on a candlestick 5-minute intraday, okay, and we have 2 days showing 8:11 and 8:12. You ready? Right below it, we have the S&P E-mini. This one doesn't say SP, it says ES. That means E-mini. Okay, it's still the S&P 500, and it's still futures. And we can see this is the September 03 contract. Everybody see the 3U in there? Okay. Notice that it is on a 5-minute intraday, that it's also 8:11 and 8:12, that the timelines are all nice and lined up. Okay. Also note that the size of the charts are basically the same. You don't want to use one real long tall one and one short long one. And you get a different perspective, okay? But here we can start to see a correlation. Can everybody see over here, starting on the left, that as the S&Ps went up, Amgen went up, okay? As the S&Ps sold off really hard, Amgen came down but flattened out. Are we starting to describe a strong stock? Yes. It wants to go up, but it doesn't want to go down. So this brings us to another cliche. You ready? If it will not go up, it must go down. And if it will not go down, then it must go up. Okay? Let's continue. So we see the S&P start to rally up and through here towards the end of the day, and of course you can see that Amgen takes off here, what, at about a 40, 35 degree angle. Okay? The next day the S&Ps gap up, Amgen's off to the races again. S&Ps start to sell off here at around 11 o'clock, 10:30 to 11 in here. Okay? What does Amgen do? Goes flat. Again, it doesn't want to go down. Towards the end of the day, we see a big rally in the S&Ps, and sure enough, Amgen breaks out of its doldrums and goes up. So here we have a correlated stock. The closer the correlation, the better the indication. Now, what you can't see here on a static chart, 1 Mississippi, 2 Mississippi, 3 Mississippi, 4 Mississippi, and all of a sudden Amgen turns green. Oh, it has a 5-second lead in it, or a 10-second, or a 30-second lead. People, this can be incredibly valuable to you. If you knew, after watching this thing for a while, that every time the S&Ps go up, that 10 seconds later, Amgen goes up, would that be a benefit to you of making a good entry? Yeah. The longest one we ever saw was about 4 minutes, okay? And it was back in 98, I think it was. Oracle had gone through some rough times and was coming back up out of the doldrums. And the S&Ps would go up, and 4 minutes later, Oracle would respond. Well, people, I can go out and have a ham sandwich and a beer and come back and make that trade, okay? And I got 4 minutes. Hey, S&Ps just went up. Listen, how about them Dodgers? Okay, we can talk for a couple minutes. I can still hit that buy button before Oracle goes up, okay? So this is why we look at these guys. This is a very, very useful tool. Now, here we have a different day and a different stock, and here, of course, you see the header. It says a weak stock. And we got, what contract is this? 2001, very good, okay? Again, I want you to quickly note that we have a 5-minute 5-day, a 5-minute 5-day, that the timelines are lined up, and that the charts are basically the same size. That's very important, people. That's why I keep emphasizing it. So here we see down here, the S&Ps start to rally on Monday and go up very quickly through 11 o'clock. Cisco makes a half-hearted attempt. Well, what do we know about September of 2001? Tech stocks weren't doing very good, okay? We see the S&Ps plateau and continue up, and Cisco starts to round and actually lose some steam. You ready? We start to really see it towards the end of the day of Tuesday here. Does everybody see how the S&Ps went down and then ran up? Cisco fell down, ran down. Look at the end here. These are 5-minute candles. So for the last 15 minutes, 5, 10, 15, the S&P's rallied. What did Cisco do in the last 5 minutes? Barely hung on. Ready? Now keep paying attention. Here we see the S&Ps gap down, but immediately start to rally up. Cisco does what? It gaps down and falls down. This whole rally in here, green, 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 red, green, 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 and red, only resulted in those 2 green candles in Cisco. So again, we're seeing a stock that will not go up, therefore it must want to go down. As soon as S&Ps start to sell off, Cisco starts to go down. The next day, S&Ps gap down and Cisco gaps down. S&Ps travel down, but Cisco doesn't go. It starts going flat. What has happened? It's no longer going down. It's reached a major support level. It can only go down so far, remember? And then somebody's going to step in and say, this is really a good buy for Cisco. Okay, no matter what the S&Ps, I'm going to buy some Cisco, and therefore the price is supported. So for 3 days, the S&Ps were highly correlated to a weak stock. But there's going to come a point where it doesn't work anymore. You have to observe for a while to see those and realize you just can't every day follow the S&Ps. But what do you think? Is this a pretty cool tool so far? Sure. What do you see it live, okay, when we actually use it? Okay, and then of course the third category, we looked at strong, we looked at weak. Be careful, not all of them are correlated, okay? Now, here is PRGO. I don't even know what that stock is. And again, we're on a 5-minute, 2-day, 5-minute, 2-day, okay? And we have the September 3s in here. And you can see S&Ps go up and PRGO goes down and sideways. This falls down, it goes up a little bit and kind of drifts down. S&Ps rally up on the next day. This one goes sideways to down. There is no correlation. It doesn't work with every stock, people. Okay? It does work with a select few, but not every stock. That's why it's very important that you not stock hop. Okay? Find yourself a set group to trade as a beginner. Don't worry. You will spread your wings naturally. As time goes by, you'll take those 2 stocks and turn them into 4, and those 4 stocks will suddenly become 8. Those 8 look up the return on equity. Well, that didn't help me much. So I'm not going to look at return on equity this time. You become more efficient and you become faster at studying. Of course, I'm going to show you how to find them. Alrighty, don't worry about that. I'm going to show you how to do that. Questions so far on this?
So how do you know what?
I'm going to drag the S&P 500 up. But if the traders in the future, the June traders, think Cisco is going to be up in June, Cisco will also go up. It doesn't matter, again, because it is a function of perception. We don't worry about reality here, guys. You know, it's when we get into charting, virtually everything in charting is self-fulfilling prophecy. How many people in here have heard of a double bottom? A couple of you have. You've read books, okay? Double bottom is a trend reversal. When the price comes down and hits support once, twice, that's a bit, they buy it. The buying of it makes it true, okay? It doesn't matter to me why they buy it. As long as they buy it, I can ride that, can't I? I'm going to buy it where? As it comes down and makes the second double bottom. I'm going to be a buyer as the price goes down in anticipation of it going up, just like the cycle we drew. Why do I want to do that? I'm a buyer. I need sellers. And then I'm going to let all the other buyers push my price way high. And when it starts to get a little toppy, when I start to see those green and yellow prints starting to switch, I'm going to sell it to them. Everybody with me so far? Moving right along. Miles to go and promises to keep and miles to go before we sleep. Now, in your books, in your handouts, you will find an exact description of these next market indicators and the mathematics behind it. Okay, I'm not going to take the time. I'm going to show you how to use them. Okay? TRIN is a short phrase. It really stands for the Short-Term Traders Index. Trader Index, T-R-I-N, TRIN. Okay? And what TRIN effectively measures is advancing volume relative to overall volume or declining volume relative to all overall volume. Now again, if you want the exact math, all you do is tonight after class is... Now the first problem with TRIN is that it's kind of backwards. As you can see up here on the chart, TRIN 1 is neutral. It's the 0 line, huh? Anything above 1 is bearish. It indicates a declining market or selling pressure. Anything under 1 is bullish. It indicates an appreciating market or inclining prices. So 1.1 to maybe 1.3, this would be what? A mild bearish sentiment. 1.4 to say 1.8 would be strong selling pressure, a strong bear. Okay? But if it gets much more than 2, it becomes, are you ready? Unbearable. Okay? So if we start getting way up there, is the thing really oversold? Yes. And so if we get greater than 2.0, then we look for a snapback. We look for the bears to break, and there may be a buying spree on. Now, people, these are general levels. Okay? You need to understand that they have to be put into context of the circumstances. I have seen TRIN run upwards to 3 and 4 before it was oversold and started buying it back. Okay? Well, what does this mean to me? Well, if I'm coming to the gunfight with my long gun and my short gun, okay, and I see TRIN is running 1.1 or 1.3, then I'm going to pull out my short gun, okay, and then I'm going to go attack the market. And as long as it's running 1.4, 1.5, 1.7, I'm happy. The market is still going down. There's a lot of selling pressure, and I want it to go down. I'm short. But if it starts, the selling gets too great, it starts getting up to 2 or 2.2, greater than 2.0, maybe it's time for me to buy cover, okay, and close my short. Now, guys, one of the things I want you to think about is you can't go broke taking a profit. I'm sure you've all heard that before. You ready? But what if we opened this trade, we went short with 400 shares, and all of a sudden the TRIN pops up to 2.2. Could I buy cover on 200 shares, take 50% of my profit, put it in my pocket, and let the other 200 go? And if the market goes down further, I'd be more profitable. But if it comes up, I won't lose too much of my profit before I recognize it and take the rest off. So closing 50% of your position is always a good idea. You know what the old adage is? When in doubt, get out. Okay? If things start to change, it's not meeting your plan, then it's time to do something. Push a button. Okay? Alrighty. Now, if we go down below 1, we see just the opposite. Perhaps if we go 0.9 down to 0.8, this is a mild bull. Okay? And 0.7 to 0.4, that would be what? Strong bull. But if it gets less than 0.3, well, here's the bad one, guys. It's too much bull. Okay? So we look for a sell-off. We look for some selling to come into the market because at 0.3 or less, it's overbought. They've been buying it all day long. Somebody's going to stop and take profits. Remember when we started this, I think I picked on Thomas, and I said, if Thomas bought 1,000 shares of Amgen, is he bullish? And we all said yes, and I said, no, he's a selling pressure. Okay? As more people buy, we're converting more and more people into potential sellers, aren't we? The more people buy, the more people want to sell. Whoever takes the profit first gets the most. So as In the case above 1 in Trin, we get up here to 2, everybody has sold. They have too much cash in their pocket. They're looking to buy. As we get down here, less than 0.3, everybody's bought. They're looking to sell. And that's why we worry about these extremes. Now, if we look up here on the chart, we see the Trin is running 0.65. Okay, that's below 1. Where are we? We're in the strong bull. Okay, what is the Dow? The Dow's up 1329. The composite's up 2290. The NDX is up 2233. The QQQs are up 69. Don't worry about the ADX line. S&Ps are up 6.09. So here we see correlation, don't we? Trin says we should be up, and we're basically green across the board. Okay, now, let me switch here real quick. Yeah, here's Trin and the S&P. Now remember, these guys are somewhat opposite. Alrighty? Can everybody see down here? Again, we have a 5-minute intraday and 3 days, and we have a 5-minute intraday, 3 days. Apples to apples. Okay, we got the S&P 500 cash index up here, and we have Trin on the bottom. And I guess I should draw a line. Everybody see where the 1 line is here? Okay. And on the 8th, we can see that mostly the Trin was below 1, but was heading quickly back up to 1 for most of the day. And we can see the market did what? It was choppy and moving sideways. What do we want to see? We want to see the thing going away from 1, and then we'll see the market go up. We see that on 8/11. Here's Trin moving down from 1. What does the market do? Goes up. Okay? As the Trin gets down here to about 0.5 or so, it starts to go back up towards 1, and we see a sell-off in the market. You ready? Again, you see the market coming down as we get up here to 1.2. You ready? And that's kind of the low of the market. Then the Trin starts to head back under 1, and the market starts to rally. Okay? On the last day here, we can see that Trin moves above 1, and the market sells off. It gets up to around 1.2 or so. This is a strong up day, or a couple days, already. And then as it moves back towards 1 and under 1, the market starts to rally. As it falls below 1, you can see the market take off, generally. Okay, now, we really don't look at graphs of Trin. I just wanted to show it to you visually. You can, but usually we just watch the numbers.
By its title, is that implying really it's a good index for short-term, intraday sort of activity?
Well, okay, you can use it long-term, but what is its name? The Short-Term Traders Index. So yeah, it's an intraday indication for us. If you wish to use it on a longer term, it was actually created by a guy named Dick Arms, okay? And it is also known as the Arms Index. But for longer day trading, they use a 3-day moving average or a 9-day moving average. Here we're using what? 5 minutes. Now, Trin and its cousin Tick that we're going to look at here in just a moment aren't really things that trigger a trade, but they're more or less what keeps us warm and fuzzy while we're in a trade. I've opened the trade for a variety of reasons, and then I look to Trin to see that the overall market sentiment is supporting me. Again, we started driving up to San Francisco for a vacation. Okay, we filled up the gas tank and stuff, we get it on the road, we're driving for about 15 minutes, and our eyes glance across the dashboard. Is the temperature gauge normal? Is the battery charge normal? Is the oil pressure normal? Are we in the right gear? Okay, you know, do you got an overdrive? Do we got the stereo turned up? So we check our indication to make sure that the drive is going nicely. It doesn't say, don't go to San Francisco. It doesn't say, stop and get a ham sandwich. It just says, the vehicle is operating normally. Okay, and if all of a sudden the temperature gauge goes way high, what are we going to do? We're going to stop our trip. We're going to stop our trade. If all of a sudden it starts going to one extreme or the other, it's time telling us maybe it's time to check things over. Doesn't mean we have to stop the trip, but maybe we want to take 50% of the profit off, put it in our pockets, and wait and see what happens. Does it come back to normal? Was it just because we were climbing a hill and the engine was overheating a little bit? Okay? So these are kind of, I want you to think about these analogies because they help you grab the concept. Okay, now, tick is the cousin. Trin, remember, I said it was measuring advancing volume versus declining volume. Tick is a little bit more straightforward. It counts noses, okay? It tells you how many stocks, how many issues are going up versus how many issues are going down, okay? So this gives us a more logical look at the number system. So to plus 800 is a strong bull. But again, can it become overbought? Sure. So if we get to plus 1,000 plus, in other words, 1,000 or greater, 1,100, 1,200, then we start to, again, get too much bull. And we look for a sell-off here. Ready? And vice versa. We go minus 100 to minus 300, mild bear. Okay, minus 400 to minus, what did I put up there, 800, strong bear. And if we get to minus 1,000 plus, minus 1,100, minus 1,200, minus, it's too much bear. It's too bearish, okay? And therefore we start to look for a snapback. So this becomes unbearable. I know that's not how you spell unbearable. It's a joke. Okay? Strong up market, okay? It might be plus 1,200 before it becomes too much bull. And it may only be minus 800 when it becomes unbearable. Okay, because what? The overall market is up. So it's hard to overbuy it. It's easy to oversell it. And again, as we look up here at the chart, this one isn't quite as intuitive. Okay, we have a plus 213. I know it's red, but it doesn't have a minus sign in front of it. Okay, so it is a mild bull. Okay, 213. Dow is up 66. Well, the composite is in green, but it's not down very much. It's only off 6.4, and of course this is a static screen. What if 5 minutes ago it was minus 10? So it would be coming up, right? NDX and all these other guys here. So this one isn't quite as intuitive as the other ones. We can go out and look at it on the platform. Well, here we have the platform. Now, we just talked about Trin and Tick. Let's take a look at them, what they look like real time. Now, this is Trin. Now, remember, above 1 is bearish, below 1 is bullish. So let's go up here and draw in our 1 line, and that looks like it's going to be this line right here. And see if I can get that flat for you guys. There we go. So running a mild bear at about 1.34 here in the center of the day. At the beginning of the day, it was actually below 1 at about 0.85. Well, what does that mean to the market? Well, let's have a look. We can do an overlay, and we'll just use the S&Ps as a good market indication. And they have a terrible color here. Let's choose fuchsia and say overlay and hide the window. So now with we can start to see a couple things. We can see that on 7/6, the market was starting to come down. Can everybody? But as it started to get up here and peak out above the 225, this is where the market started to stabilize. It dipped a little bit more and then started coming back up as Trin was coming down. So this is kind of like a mirror image, isn't it? You ready? Now today, we see the trend, okay, went down underneath 1 down here right at the get-go at 9:30 to 10 o'clock. 2 o'clock, it was back at 1 and the market started to rally. Well, how come it went up so strong here and trend isn't clearly under 1? I mean, it's right at 1 or 0.98, whatever, okay? Well, realize that we had such a massive sell-off yesterday. Now let's look at this backwards just a few more days and it'll give you an idea. I'm going to put this on like a 5-minute candle and let's go back 10 days so you see more of the correlation. Okay, so, got to turn off that crosshair. Put my cursor there and right click, put in a horizontal line. There it is. Oh, I missed it by a hair. Well, 0.99 will have to do. Okay, let's look back here on 623. We can see that trend was well underneath the 1. It went sideways and drifted off. The market went up, went sideways, and rallied up to the close at the end of the day. Just the opposite of what the trend did. The next day, trend opens above 1, but starts immediately heading back towards 1. So the market didn't know quite what to do, and it started drifting up, sideways to up a little. Near the 1, okay, as the market goes up. But as it crosses back above the 1, we can see the market stage down to a much lower close. Okay? How about here on 7-1? This has got real exciting. Okay? We can see that trend shot above the 1 line, and the market just came down really hard. And trend was up there all day long. You can see that there was very few turnarounds. Now, I told you that when we got greater than 2, that we start looking for the thing to be oversold and that we might have a buying little rally in there. Well, let's put a crosshair on this and have a quick little look here. And on 7-1, it got all the way up to 3.50 before there was any sort of a buying rally in the market. So remember, these numbers that we give you are general numbers and have to be looked at from the overall perspective. This is only one indication. We can't say, oh, exactly at 2.2 the market will turn around, because it may be just a really grim day. Geopolitical events, terrorism, really bad economic news could make it go really make it hard to be oversold, which was the case here. Okay. So any questions on trend? Okay, again, I haven't done the math plus declining volume. So this gives it a kind of an inverse relationship. Okay, any other questions on trend? I want to show you how to use this stuff. Not if you want to know all the math, like I say, it's in your handouts there. Okay, let's switch over. And the next thing we talked about as market indication was tick. Now, I'm going to tell you right up front, this is hard to look at, guys. Okay, yeah, isn't that a nightmare? Here, let me get rid of this thing for a second. Now, we can see that in the last week or so, how thin the market's been. What did I tell you? The market becomes overbought at plus 1,000 and oversold at minus 1,000. Well, let's put a crosshair on this. And again, I'm not trying to pick out the perfect tops, but if I were to grab an awful lot of the trades or the ticks here across these 10 days, can everybody see there on the right-hand side? It says about 855, as little as about 368. But this was a couple of very weird weeks, very narrow trading, very light volume, holidays were involved, that kind of stuff. So this may not look at its best here. But let me give you another point of view on this. What if we were to look at this over the course of the last year or so? Okay? Yeah, I know, that's really bad looking, huh? But how about 2003? Wasn't 2003 kind of a bullish year? Yeah, it was. It really rallied up there strong. And if we look up here, over here on the left-hand side, we can see we're picking up an awful lot of the tips of these tick charts, okay? And they're what? They're up here in the 1100s. So it was very difficult to overbuy because it was such a bullish rally. Yet on the other hand, if we come down here and we pick up a bunch of them in 2003 on the left side, it was easily oversold. So there was a bias, okay? There was an overall bias in the market. As we got into 2004, everything kind of stabilized and we started even going down a bit. And again, you can see this. If I picked up a lot of these tops in 2004, we can see now we're about 1131 on the top side, okay? But the bottom side has expanded to about 835, 8. So there's a shift of about 100 to 150 from low to high. Does everybody understand what I was talking about? Again, if I even go back further, and we were to look at this thing, you know, back in 2000, okay? Now we can start to really see, here's our 2000. You can see, let's put the crosshair on it. In 2000 and 2002 in here, we were overselling at about 900, 885 somewhere, but we were overbuying at 929, somewhere in that neck of the woods. So obviously during 2000, 2001, there was a big major sell-off. This was very bearish, and it was hard to get these. Do the overlay, and let's see what we can see here. Okay. First off, on the left-hand side, we can see where tick got up here. Let's put the crosshair on it so it may be a little bit more clear for you. Tick got all the way up to what? 1325, okay, and that's right where the market peaked out and started turning around and coming down. The market got all the way down here to minus 595, but it didn't perk up until 10 minutes later. Okay, you can see this little tiny rally just towards the end. How about on this right here at about 1230? Tick got as low as minus 428, 429 in there, and that's where the market started to turn around and go back up. Okay, again, people, I show you all of these. I like trend better than I do tick, but you may like to look at this and see what the correlation is for yourself. Okay, any questions about tick? Okay, you guys had the question about trend, about the math, so let me do the tick. Tick is pretty easy. It is simply advancing issues versus declining issues. How many stocks are going up in any given 5 minutes, in this case, compared to how many are going down? And that's what sets tick. Everybody with me? Very good. What did I tell you this morning I expected to happen? I said the market's going to open up strong, but by the end of the day, we'd probably have a sell-off. Okay, well, that's what's happening. It's how did I know that? I didn't, people. I looked at what the probability of it was, and the odds were in my favor that I'd be right because of the geopolitical unrest. We had good news in the tech sector, and that caused everybody to go, hooray! And then we looked around and said, well, if we blow everybody up, it's going to be hard to sell a chip. Okay, and that's why it's probably coming down. Now, there are other indications out there, and when we get into technical analysis, we're going to look at them in a lot more depth, but I just want to give you a couple more quickies on technical or market indication. We have market breadth. And remember I said if you're going to build a pyramid, it's a lot easier if you lay a lot of big, wide foundation. For the market to go up, you've got to have a lot of people playing the game, okay? And we don't want to see the Dow or the NASDAQ shoot up 2-3%, but only having 5 stocks doing it. We want to see 100 stocks doing it, okay? So we look at the advanced decline line, and this is seeing how many stocks are advancing compared to how many stocks are declining. And generally, for a strong up day, we need to see a minimum of 2 to 1. We would like to see 3 or 4 to 1. And 1,601 stocks declining. That's a directionless market. Conversely, we know we're going into the doldrums or into the dumpster if we hear just the opposite. 1,100 stocks were advancing and 2,400 stocks were declining. That's more than 2 to 1. So all we do is watch our advanced decline line, and that will start to give us some, it tells us whether our stock has timbers under it and whether we have support. We're looking at playing a single stock, but we want to know that all these indications are supporting it. I want to see a situation that looks like this, guys. If I'm thinking long, okay, I want to see my stock ramp up. But do I want to see a lot of support? It's time to take some profit. Trend starts going to 1.2, tick starts going to minus 300, the advanced decline line starts going even or down. It's time to take the money off the table, people, and put it in our pockets. Okay? CIP, cash in pocket. Alrighty, that's the other indicator. CIP is the best, cash is king. Another indicator out there that you've probably heard, and it's not available on all platforms, but it's available on all financial websites. And that is the amount of stocks hitting 52-week highs or 52-week lows. Obviously, in a good, strong bull run, you're going to hear 300 stocks hit their 52-week high and only 2 hit a 52-week low. And conversely, in a down market, you would hear just the opposite. Wow, there were 75 stocks hit new 52-week lows and only 1 stock hit a 52-week high. Again, we're talking about my ramp over here. Does it have support for what I see in the market? And if we expect it to go up, we want to see a lot of other stocks going up too. Market breadth. The width or bottom, foundation, however you want to call it. They call it breadth. Now this is really interesting, and I want to go through this. One of OTA's associates is a Dr. Peter Navarro, who's a Harvard PhD in economics, okay? And Dr. Navarro writes for us, guides us in what he calls macro wave trading. A couple of you guys have said, well, what if I hold a stock for 2 or 3 months? Am I an investor? No, not if you have a plan. You're just a longer-term trader. And Dr. Navarro happens to be one of those people. He trades different cycles. And that brings up the question, what is sector rotation and how do cycles work? And again, you'll notice that this looks remarkably like my price cycle that I put on the board. Now, in the market, in the United States, we have 2 major cycles. And we see the red one up here is the stock market cycle, and then the yellow one is the economy, okay? The economic cycle or business cycle, okay? The stock market always prices things in. They always anticipate. We think things are going to be good before there's actually indication that things are good. And we think things are going to be bad before things actually are bad. So if we looked at the top of the red there where it says peak, okay, that might be March of 2000. We ran up for a bunch of years and we hit the top of the cycle there in March of 2000. But notice that the yellow cycle is displaced to the right. There was actually about 4 to 5 months before we started seeing a weakening in our economic indicators, before GDP started coming down, before unemployment went up, before the purchasing managers fell below 50%, the market was already going down. Okay? So we can suspect that as we come out of this down cycle, that the market will start to go up before we see economic indication. Now, we started seeing good economic indication in March of 2003, but the market was already going up by that time. Okay? What else was happening in March of 2003? Iraq War. And later, before the economy starts to respond to what the market anticipates. Is the market always right? Well, over the course of 100 years or so, yes, it is. But over the course of a couple of weeks, no, it isn't. Already, the market may fluctuate while the economy's okay, and start to come up. Transportation industries will start to pick up. Transportation, airlines, trucking, rail, shipping. Why? Because we got to bring in raw materials in order to start building things. Does that make sense? Okay. As we move a little bit further, we move up into number 2. Now the technology starts to rebound. Why? Well, we got the raw materials, we got to do something with them. We got to think of a new way to build a better, faster car, a new way to make a more sleek, hand-lined, hand-contoured cell phone. Okay, so technology starts to pick up. As we get into middle bull there, we start to see capital goods pick up. Why? Well, now people are going out and they start buying bigger machines to make cars faster. People start buying airplanes. United Airlines needs a new airplane. Well, I guess they don't. They're still in bankruptcy, aren't they? Anyhow, then we start moving into 4. At this point, the engine is really starting to cook, and there's a huge demand for the basic industries and materials. And then, of course, at the peak of the cycle, the economy is hitting on all 8 cylinders. Everything is moving. So we have a huge energy demand. We need electricity. We need oil. We need natural gas to keep industry churning along. As we start to peak out, okay, people start to lose their jobs. So we're at number 6 now. So the next sector to start to go up is consumer staples and healthcare. People start becoming worried about what? Their health insurance. They have to buy outside insurance. Their employer's no longer providing it for them. They start taking care of themselves. As we start to go into the early bear and middle bear, we start to see utilities go up. Why? Well, first off, utilities always have a really nice dividend attached to them. So people jump out of the stock market, which is failing, and put their money into more conservative things. But what else is happening? Is unemployment going up? At this point, on number 7? Yeah, more and more people are being thrown out of their jobs. So what are they doing? They're staying at home. They're burning more heating gas. They're watching more television. The lights are on longer. They're taking more showers because they don't go to work. They're hanging around the refrigerator, okay? The door's open, the eggs are getting cold. As we get into the late bear, okay, we start to see the financial picture pick up. Why? Because our government is now cutting interest rates. And that's good for financials. They get to lend more money. They get to have more business. So the financial sector starts to grow. And finally, number 9, the consumer cyclicals come in. Why? Joe is completely out of a job now. And the only thing he can afford is beer. Okay? So he's outgoing. He's going to the movies. He's buying a few things for around the house and a little bit of entertainment, very quiet entertainment for himself. And that's the cyclicals. Okay, he's buying bread and beer, keep himself alive. So this, and then of course the system repeats again. And this goes on and on and on ad infinitum. Now, it used to be that this cycle would actually take upwards to around 15 to 20 years to complete. Okay, but as the global village, all of you sing Kumbaya now, okay, as the global village became smaller and tighter, okay, the cycles start becoming faster and faster. So we saw this thing ramp up from basically 1994-95 up through 2000, and we're coming down through 2003, 2004. It looks like we may have hit the bottom, okay, and moving up. I say may. Let's do another cliche, guys. If you think you've seen the bottom, you're wrong. If you know you've seen the bottom, you're too late. Okay? So don't be a bottom picker. Okay? One of our instructors, Mitch Carriaga, he always tells the students, he says, if you're a bottom picker, you're going to come up with dirty fingernails. Ew. I don't want to go there.
This trough was what year?
Which trough?
The first left-hand.
Left-hand, hard left hand would be probably like 94, 95, which was our last recession. It was not the 98 dip. And the one before that was like 90, 91, right after the first Gulf War. Okay? Okay, the next question is, if we're going to look at these different sectors, okay, perhaps we need to look at the indexes inside of them. One of the things that you can do with your platform is put up a whole list of sectors. And these platforms, I didn't show you this, but you can sort them like you can Excel spreadsheet. You just click on the column header and you can sort them according to their, you can put them alphabetical order if you like. But what we sorted here on this chart is by percent change. So we can see the best today is HGF, which I believe is healthcare, and the worst is BDK at the bottom, which is biotechnology. Okay? So now we get to see which sectors are running hot equipment that makes chips. So that would be a related sector. Not the same sector as the chip makers, but certainly in the same industry. So this would, again, give us a way to feel, a way to gauge how the industry that we're playing is running, the industry and the sector. Okay? We can get even more refined. Yep, here, excuse me, I forgot about this guy. So here's a relative sector strength, and we can see, oh, where's my laser pointer? I always set that thing down. We can see here on 815 how the biotech sector fell off sharply, but Biogen, which happened to be part of that sector, rallies up. Okay, so here we see Biogen very strong. Why? Well, Biogen was in merger talks and was bought out by IDEC, okay, and that was when they made the announcement. So even though we see that the sector was overall weak, the stock had a very, very small percentage of the biotech. You think it would have had any effect on it? Probably not. The sector may have been down all day long. So therefore, we need to look inside the sectors and find out what our percentages are. Now, here's the Philadelphia Semiconductor, okay? And you can see up at the top here we have KLA Tencor, or CLAC as we call it, Maxim Integrated Products, and Linear Technology. These are the three heavy hitters. They account for 12, 9, and 9%, 12, 10, and 9, okay, of that sector. So obviously, if there was good news in Clay Tencor, which is, look at the other guys. I mean, these guys are 3s, 4s, and 5s. This one's going to have what? Twice as much influence on the overall sector as, say, Teradyne at 3.9% would. Make sense?
So they're weighted.
Yeah, they're weighted. You know, they have more value to them. So you need to know that.
Just like the Dow Jones, right?
Just like the Dow Jones. Now, some sectors don't have significant domination. So here you could drive yourself crazy looking for a leader, and notice that it's 6 to 5.1. They're all about the same. So now what's going to happen? Well, in the last example, Clay Tencor, CLAC, was the biggie. What if the sector went down but CLAC wanted to go up? Could CLAC break away? Yes. But if this sector, and this is biotechnology, okay, if this sector goes down, it's likely to drag one of these guys down with it because they're not dominant. That makes sense?
So you're a little crazy with Biogen. Trying to figure that out.
Yeah, Biogen was kind of the break on here, but you'll notice that Biogen is off the list here. Oh, there he is. He's still there, okay. But that was just happened to be extraordinary news because they were...
Let's use a more realistic picture of what the sector is doing, because being all pretty equal, right?
Oh yeah, you get a better sentiment on this guy because everybody's even Steven. Whereas on the other one, you could have exotic news in one company and the sector may or may not react to it.
But you might be with a different company and it gives you a false indication, right?
Well, that's why you want to check the sector. Obviously, if I was playing financials, I wouldn't be looking at the biotechnology.